Let's discuss bargain hunting in gold and silver. My next guest is an expert in that field. He's the president of the American Gold Exchange, and he's none other than Dana Samuelson. Dana, it's great to have you back on the program. Last time you were on, you were spot on with your predictions 3 months ago. The market has done a complete 180 since we last spoke. Great to have you back on. Let's see what you got in store for us.
Hi, Kai. It's great to be with you. Always enjoy talking with you, and really happy to catch you up on what's happening in my little world.
Yeah, absolutely. I promise you we get you back on early February after, so the worst of the winter is over, and the markets seem to find a bit of direction actually after our last conversation, because we spoke, I think it was early November, late October, right after the New Orleans Investment Conference, and DXY ran out of steam. Gold gained massive momentum. Silver sort of a little bit of momentum, for lack of a better term, but gold shot up to $300 since we last spoke. I think I know I wrote it down because I was listening to our interview earlier. Gold was at $16.50 when we spoke. Today we're at $18.70. Silver today is about $22, but it shot up to $24. Massive change, like trend change. What triggered that, Dana? Let's start there maybe, and then we'll jump into some detail.
Well, of course, inflation has been the driver of all markets for the last year, and we've seen inflation come down a bit over the last 3-4 months since we talked last. We have entered into a bit of a disinflationary period, or the disinflationary process has started, is what Jerome Powell said the other day during his press conference. So the extreme dollar strength that we saw through early 2022 into October, when the dollar peaked against almost every major currency, we've seen that reverse as the expectations of inflation waning a bit have occurred, and bond yields have rolled over, which have been a primary driver of this whole inversion back towards a more normal market. So the dollar has fallen from about 114 on the dollar index to about 103.5 today. It was actually a bit lower. The euro, the yen, the British pound have all made major recoveries. They were all at 20-year lows against the dollar the last time we talked. And this pressured gold to cyclical lows, and silver to about a little under $18, gold to $16.33 on the low. And since early mid-November, we've seen the dollar lose a lot of ground as the bond yields have rolled over a bit here in the U.S. And gold has made a really sharp rally, up about 18% at one point in time, from 1630 to 1930. Silver from a little under 18 at 1775, all the way up to a little over 24. Now we're in a correction following Chairman Powell's the Fed's rate hike of a quarter point just a few days ago, but more importantly, his continued resolve discussing the federal funds rate and how they're going to hold it higher for longer to try and keep this first major wave of inflation in check, because they know back in the 70s when inflation got out of hand, there were 3 successive waves, each wave bigger than the previous one, and they want to snuff inflation out on this first wave. So even though we're seeing better numbers on inflation, the Fed is going to be resolute in trying to hold rates higher longer to make sure they snuff it out before it has a chance to really take hold and make a second surge.
You use the word correction, and I threw a question at you before we hit record, like whether you do see a trend change again, like we saw back in November when we spoke, early November, like the market did a complete 180. We're definitely losing momentum in the gold and silver. You use the word correction. Like, do you want to define that for us real quick? And like, how is that showing? And should we buy the dips?
Yeah, I do think we should buy the dips, because I think we are in a new uptrend, and a big one, and I'll explain why in a minute. But gold has made a really big rally. Nothing but gains for 2.5-3 months. Silver, the same thing. Silver was up about 22 to 24% from the lows, which were oversold lows. So we're back into where I would call gold and silver fair value. relative to the debt we have, the economic situation we have. And we were due for a bit of a pause or a pullback on profit taking. And that is what I think we're seeing. And it's been driven by a couple things. One, the Federal Reserve's resolve against inflation. So they're holding the Fed funds rate higher longer, getting it over 5%, which they're getting close to now. And they're saying they're going to keep it there for longer than most people expected. That's helping to buoy bond yields back up and buoy the dollar back up a bit. So that's causing the correction. We also got a jobs report for January 2 days ago here in the U.S. of 526,000 jobs, I think, which was more than double market expectations, which was gigantic. But I don't think that jobs report is really as solid as most people think. I follow a couple different sources. One of them is Danielle DiMartino Booth, who is a former Fed advisor to Richard Russell at the Dallas Fed. And she is really great staying up on all the minor statistics that lead to the big statistics and the leading indicators. And according to Danielle DiMartino Booth's Quill Intelligence, since June of last year, 166,000 full-time jobs have actually been lost, where 419,000 part-time jobs have been created. So the job numbers that we're seeing may ultimately be more people taking second jobs than not. And the underlying economy is actually weakening, but not as much as we had thought it might 2 or 3 months ago. So that's helping to buoy the dollar right now, buoy bond yields, and put a little pressure on precious metals. But in the bigger picture, if you go back to when gold was first allowed to float at free market pricing in the early 70s, there's been 10 times bond yields have peaked. And following each bond yield peak, gold has gained about 18% in the subsequent 6 months to a year. And this is a period in time right now where we're in a very similar situation, where the federal funds rate is actually rising, but bond yields have peaked and are rolling over a bit. Right now, it's going to be choppy for the next several months till we really figure out whether the recession that a lot of economists have expected here in the U.S. really materializes fully or not. Now, the effects of the federal funds rate hikes have a lag on the economy, and they're to slow things down, to dampen down demand. And we're just right now in that period where the full effects of these rate hikes since March 2022 are going to be really materially felt. So the first quarter into the second quarter of this year in the U.S. is really going to be where the rubber meets the road. But more importantly, we got into a very similar situation with gold and the precious metals in the spring of 2019, when there was a global economic slowdown that began in late 2018 that the Fed was late to cut rates on, but the bond market led, and bond yields fell while the federal funds rate was still up at about 2.5% at that point in time. That was the key that unlocked the door to substantially higher gold prices, and gold got over $1,375 US for the first time in 6 years, and rallied all the way up to about $1,675 before COVID hit. And right now we're in the same exact setup. In fact, I just put a market video update out to my database last week detailing this. So the difference right now is it's going to be choppy for the next few months till we really determine whether we're going to go into a full-blown recession or not. And if we don't, what could happen may not be as fully felt as what I think might happen. But I'm not so sure that inflation is going to get damped down back to 2% easily. I think it's going to channel between 4 and 5% here for a while. And if the economy materially slows down, bond yields will fall, and the Fed's still going to hold the Fed funds rate up. That is really where gold has explosive potential higher, well over, $2,000 and $2,100, $2,200 range. It's not going to happen quickly, but I think the setup is in place right now. So we'll just have to wait and see whether it manifests or not.
Yeah, it seems like it's building a bit of a coiled spring approach here. It might just explode higher, like we've seen actually from November until like last week. That was a $300 move in gold. That is massive. As I said,
No,
18,
huge.
19%, right? That
Yeah,
is for
huge.
gold, for such a conservative asset. That is a massive, massive move. And interesting, like you mentioned, of course, inflation and inflation targets of 2%. I was in Arizona last week and I drove past a massive, massive construction site for a new chip plant just outside of Phoenix, right? I just can't believe that inflation is going to be back down to 2%. Just looking at that and deglobalization, again, that's my 2 cents on that matter, but that's just an observation as well. Bringing production home is no, sorry.
No,
I want to just like elaborate quickly on that soft landing approach. Like, do you really see that happening? Like, what you described is pretty much the buzzword soft landing.
well, I'm an armchair economist, so this is not my field of expertise, but I study it quite a bit. I think a soft landing is possible, but they're really trying to thread the needle, and it's improbable in my view. But do think it is possible if everything just falls into place just right, which it could, but I don't think it's the likely outcome. Uh, these things never quite work out the way they should, and they tend to go to extremes before they reverse, and they can reverse hard. And I just don't trust the jobs figures that we're getting out of the U.S. I don't think the economy is that great. Manufacturing slowing down. There's already a recession in the housing market here because of the substantially higher interest rates. Layoffs. Jobs are the last thing to roll over. They're a lagging indicator. So if you look at any recession and you look at a jobs chart, gains or losses on top of a recessionary periods, they're always the last thing to go, especially right now, because businesses have been competing for workers. And once they get a good worker, the last thing they want to do is let them go, right? Because they're hard to replace right now. And that's because we've seen the workforce. There's just less people in the workforce right now because of COVID. A lot of people have dropped out and just haven't re-entered. There was a second point about the jobs market, and I've lost it. So excuse
We'll
me.
get back. No, we'll get back to that. No worries.
Oh,
Dana,
yeah, I
go
got
ahead.
it.
Go ahead.
When businesses really have to cut, jobs or employees are where they get the fastest overhead reductions. So that's another reason why jobs are one of the lagging indicators.
Okay. Good, really, really good points. I've been watching it as well. I've been watching tech layoffs in particular, but I think there's been an overhiring going on during the COVID times as well. So we'll see how that balances it out because it's not going rampant yet, and unemployment rate is nowhere near critical levels in my yet. So,
Right, you're right. Tech companies overhired, so now they're rebalancing, and they've got a ways to go to get back to where they were pre-COVID. You're right about that.
so really curious to see how that plays out. We focused our conversation a lot on what's going on in the U.S. Fed comments, looking at what the U.S. dollar is doing. Do you have also a couple of like global points you look at, like some macro, like other macro topics? I just read this morning actually Russia apparently has been selling gold to cover like gaps in the fiscal budget at home. Is that something you've been hearing as well? And what other geopolitical or like global influences do you see sort of playing out here on the gold price?
Well, there's three things. One is what you said, Russian gold sales. There were alleged Russian gold sales last September and October, which helped to put gold down under 1700 to 1630. So there was abnormal pressure there. I do think China has been stepping up to the plate and taking advantage of the lower gold price. And they're one of the reasons why they're buying, which I think they bought 30 tons in the third quarter of last year, has helped to buoy the gold price back up. And that is a telling sign. So they're value shopping in the gold market in dollars. China, of course, is the second largest economy in the world, and COVID has hampered them. We are going to get a bit of a China reopening bounce this year. Now, how quickly and how much or when it really fully starts in earnest is going to be hard to tell, but it seems like it's starting already. So that's going to help to buoy the global economy a bit. But the global economy has really been undermined by inflation, by loss of purchasing power by every other currency in the world. So not only do they have inflation, they have lower buying power in their currencies versus the dollar. and other and commodities. And you said globalization has been, completely fractured. We're not going back to that. And now the war in the Ukraine could continue on. The Russians are potentially going to have a second wave of 300,000 or 400,000 troops coming into the Ukraine to fight, and we're ramping that up. So we'll have to see how that really, goes. But it doesn't look like, the Ukraine has just been tenacious in fighting back the Russians. And but Russia's they're not going to let go. They're like a bulldog right now. They've got their teeth into that country and they just don't want to let go. So it's going to be choppy for a little while, probably maybe a little bit longer till we really get some real economic direction, which will drive everything.
And it's like last video we talked about, or I titled the last video, the Royal Silver Squeeze, right? Based on, silver being in short supply due to the UK or England having to remint some of the coins, silver coins, due to the unfortunate, or due to the death of Queen Elizabeth back now, and transitioning to King Charles. Where do we stand now? Because I'm a bit irritated coming to the silver squeeze, because the Silver Institute is saying we're going to be in an oversupplied market this year, meaning we're going to have an excess of 100 million ounces in the market. What do you see? Because you're way deeper into it, especially the physical side.
Well, since March of 2020, all the way through November of 2022, into November 2022, demand for physical precious metals was just extremely strong, which strained the ability of the mints and the refineries to produce sovereign minted gold and silver coins and bars. And noticeably, in November, right after we talked last time, we had 1 week in the second, third week in November where our business was just really quiet. And it was the same way across the entire precious metal spectrum and physical precious metals markets here in the U.S. It was right around the time of the U.S. congressional election. So I don't know if that really had anything to do with it or not. I think it's more to do with we're getting near the end of the year, and inflation is really taking a bite out of the ability of people to buy things. We've seen savings fall to their lowest level in years, and credit card debt explode to its highest level in years. So consumers have been increasingly depleting their savings and relying on credit card debt to supplement what inflation has taken out of their paychecks. And 40% of the American public has no assets. They're living paycheck to paycheck, and they literally have no assets. So demand for physical precious metals abated pretty quickly mid-November into December. And this was also the time, which was the first time we've seen it really fall sharply in 2.5 years. At the same time, the mints around the world were all transitioning from the 2022 issues to the 2023 issues. And we've gotten a real big supply surge into the market at the same time demand was falling. So we've seen premiums for physical silver on the street to the public collapse back down to pre-COVID levels for almost everything. Now, U.S. gold and silver eagles are still in short supply relative to every other country: Great Britain, Austrian Philharmonics, Australian kangaroos, South African Krugerrands. So the U.S. gold and silver eagles are still in modest supply strain, and the premiums are higher than normal. But everything else is trading at 100-ounce bars, trading at basically back to pre-COVID pricing again, which is great for the consumer.
Yeah. What's your preferred seller right now? What do you offer? There's like last time you mentioned, I think it was the Krugerrand with the lowest premium. Like, what's your preferred product these days?
Well, I like all the sovereign minted products. I just go for the lowest price, right? Because they're all good products. Usually if it's Eagles, it's U.S. gold and silver Eagles, number one, Canadian gold and silver Maple Leafs, number two, because we're in the U.S., and these are the two favorite products here. But the Canadian gold Maple Leafs have reporting requirements that U.S. gold Eagles do not, as a quirk with the IRS going back to 1986. So we do sell a lot of Austrian gold and silver Philharmonics. We've increasingly been selling gold and silver Britannias from Great Britain with Queen Elizabeth's portrait on them. Now they're changing to King Charles because the British are trying to break into the U.S. market, and they've got lower premiums than Philharmonics by a little bit and the Krugerrands by a little bit. So But maple leafs are getting cheap again now, especially. They're trying to compete again.
Awesome. That's really, really interesting. Yeah, sort of unsqueeze the silver squeeze, I guess. There's a term you used before we hit record. Really, really interesting developments. Forecasting is difficult. Like we tried it a little bit. Do you see, like I hinted at this, oversupply on a, quoted the Silver Institute here. Do you see that like sort of persisting for the next 12 months then? Is that, or do you see anything on the horizon that could change that? All right, listen up. I just made a bit of a plunder by saying the silver market is in an oversupply. No idea where that came from, and I fact-checked myself. Of course, we're not in an oversupply situation. The market is undersupplied. There's a supply deficit in the silver market, and the Silver Institute just came out with some more details. Can highly recommend this news release from the Silver Institute that came out only on February 8th here, and it's talking about that the industrial demand for silver is growing exponentially, 2.6% in year over year to 550 million ounces, and silver supply from mine production is, it's still at a higher level. It's going to rise to 873 million ounces, but there's still a deficit. And the Silver Institute suggests that there might be a deficit of roughly 115 million ounces. And I'm looking at it here. Silver supply, you can see that it's expected to rise to 1 or pretty much 1 billion ounces of silver. But silver mine production, roughly, the highest since 2016, expected in 2023. Really interesting stats, but we're still in an undersupplied situation. That is key, and the silver market is going to be in a deficit. It's been the first deficit, or actually, the silver market transitioned to a deficit in 2021 for the first time in 6 years. 2022, the deficit then surged to 250 million ounces. That's massive. That explains the very low levels of registered silver on the COMEX, and it is projected to be a deficit of 119 million ounces for 2023. So I wanted to throw that in because I have no idea where I said oversupply. I wanted to fact check myself and correct myself here. Now, back to the podcast.
Well, when you're talking about total number of ounces on the market, right, with the silvers.
Yeah.
Yeah, right. So, we've always, my entire career, we've lived with pretty much oversupplied markets for physical metals. Now, not necessarily fabricated metals, but we also have seen, and I didn't update this before I got on with you today, but something to look at is how many available ounces of silver there are for delivery in the COMEX warehouse. Now, that has dropped from about 150 million ounces a year ago down to about 35 million ounces in the last 2 months. And this, there's available silver and then there's registered silver. Available silver is what's available for delivery that you can take against a contract expiring. Registered silver is silver that the warehouses have in the stored at their warehouses, but is not available for sale. And we've seen the available amount of silver drop dramatically and close to a tipping point because, the U.S. Mint can make 25 million ounces of silver eagles alone in a year, and then they've made it in some months when demand has been really high. Now, the production is impacted right now. On big years, the U.S. silver eagles, there have been 45 million made in a year. So we are seeing a potential tipping point in what is available in the COMEX warehouses. And if there's going to be a surplus of, say, 1,000-ounce bars this year, that would help to buoy that back up and maybe take the pressure off. But if we do get to a full tipping point, because of the offtake of silver has been so strong, silver has explosive potential, $30, $40, $50 an ounce relative to gold at these numbers. Because I think, gold is close to an all-time high where silver is still half of its 2 previous all-time highs of about $50 US.
Yeah, it's been bouncing off the $24 level. Like if you look at the chart of the last 30, 45 days here, it just ran up 24, bounced off, 24, bounced off. Any explanation? I'm not a technical analyst, so any indication why that might be? Why is that level so important?
Well, it's just, support and resistance on the charts. And we got a lot of computer trading these days. So the algorithms, I can literally watch the computers trade the metals on the COMEX exchange, and tell, gold's going to drop $5 in the next 5 minutes. And you got to be right on it because it'll drop and it'll buoy up a little bit. And then all of a sudden it'll plunge. And you can see it coming. So these are algorithms that are doing a lot of trading. So when you get a big run like we've had, there's some natural profit taking. Fibonacci numbers come into play. 36% retrenchment from a high in the short term, 18%. So I think we hit pretty high numbers pretty fast, and now we're seeing profit taking, but we're seeing support about where we should. In gold, it's 1850, and silver would be about $22.
No, fantastic. It is looking good. Like, and you might use the word correction. Fortunately, I was like, I don't know. I'm still skeptic. Maybe I've been hit over the head way too many times in our sector, especially being involved with junior mining stocks and in the gold space over the last 12 years. Too many false breakouts. Too many false hopes, I guess. So I
Right.
always appreciate your insights there, Dana. Where can we find more of you? It's been super insightful speaking with you. Like, you have a blog, I think, as well.
Well, we have our website is our company's American Gold Exchange. I think you can see my web address,
Oh yeah.
www.amergold.com. My head is blocking it a bit. That's where our website is. We have a YouTube channel for American Gold Exchange where I've now been putting out videos of market commentary. We used to do email market commentary and writing, and just the market was moving too fast and too sharply through all the changes the last couple of years. So we had to go to a video format so I could do it more quickly, because I'm a slow writer. I'm a bit faster talker.
No,
But I do think, it's going to be choppy, and, we're not out of the woods yet. We could see prices go a little lower. It all depends on bond yields. Really follow the U.S. bond yields, the 10-year, the 20-year, and the 30-year relative to the 2-year. We're in a big inversion right now, which signals a recession in the U.S., which we haven't seen yet. But the bond yields are really going to be the key over the next 3 to 6 months. Follow them. They'll lead the dollar and U.S. economic news as well.
absolutely. Fantastic, Dana. Fantastic conversation. Always appreciate your time. Thanks so much for coming on.
Thank you, Kai. It's great speaking to you. I love having someone who really understands our market to discuss these things with, and really respect what you're doing. So thank you for having me.
Glad to have the white light on. Otherwise, you'd see me blushing right now. So really appreciate it. And everybody else, thank you so much for tuning in. Let's make sure to get you subscribed to this channel, because I know 85% of you watching are not subscribed. What's up with that? Change that. Hit the button. I think it's on this side down here. Hit that button. It says subscribe on it. Really, really appreciate that. I hope you enjoyed the content. Leave a comment, of course, as well. Where do you think things are headed? Is this a correction? Is this a drop-off? Are we seeing a complete 180-degree change again in markets? Let us know. What do you think? And we'll be back with lots more content. Thank you so much for your time. It's highly appreciated. Thank you.